When you have a C Corp that owns LLCs, it's a smart way to handle many different business projects all together. This setup can help you pay less in taxes and keep your personal stuff safe if any of the businesses run into money problems. Making a C Corp owned LLCs puts a safety net around each project. So if one business has issues, it doesn't cause trouble for the others. This way, you can run multiple projects without worrying that a problem with one will hurt the rest. It's a good strategy for keeping things organized and reducing risks. And by the way, if you would like to get help in starting your own C Corp, then make sure to sign up with Northwest Registered Agents by clicking my affiliate link down in the description of this video. They're professionals and they'll be able to help you out with any legal questions you have. Plus, clicking on my link doesn't cost you anything extra and it helps me support the channel. And with that in mind, let's get started. When you're thinking about starting a business, one of the first big decisions you'll face is choosing the right structure. The rest of your business will be built on this, so it's important to get it right. The idea of having a C corporation own several limited liability companies might seem like a complex strategy, but there are compelling reasons to consider it. First, let's talk about asset protection. In the world of business, things don't always go as planned. If your business faces legal issues or debts, you don't want to lose your personal savings, house, or car because of business problems. A C Corp owning LLCs creates layers of protection, separating your personal assets from those of the business. Each LLC acts like a container holding its own assets and liabilities. If one LLC faces a lawsuit, the others and your personal assets are safer. Tax benefits are another big reason. Taxes can take a big chunk out of your profits, but the right business structure can help you keep more of your money. C Corps are taxed separately from their owners, which can be a downside due to double taxation. The company pays taxes, and then shareholders pay taxes on dividends. However, when a C Corp owns LLCs, the LLCs can choose how they're taxed. They can pass profits directly to the C Corp, potentially avoiding double taxation on those profits. Operational flexibility is also a key benefit. Different LLCs can pursue different business activities, work in different states, or hold different assets. This setup allows each LLC to operate somewhat independently with its own management and operational strategies, while still being part of the larger corporate structure. This can be especially useful if you want to experiment with new business ideas without risking the entire company. Setting up a C corporation involves a few key steps that lay the groundwork for your business's legal and operational framework. This process is where everything else will be built. Firstly, you need to file the necessary documents, typically called the Articles of Incorporation, with the Secretary of State in the jurisdiction where you intend to establish your corporation. This document includes essential details about your corporation, such as its name, principal address, purpose, and information about its shares and initial directors. Think of this as declaring to the state the existence of your business and how it intends to operate at a high level. Creating bylaws is the next critical step. Bylaws are essentially the rulebook for how your corporation will be governed and run. They cover procedures for holding meetings, electing directors and officers, and other essential governance matters. Crafting well thought out bylaws is not what people see, but it's essential for making everything work smoothly. Appointing a board of directors is another important step. These individuals will have the responsibility of overseeing the corporation's affairs, making significant financial decisions, and setting broad policies. This group is like the architects and general contractors for your house, tasked with making high-level decisions that will affect the entire structure. After establishing your C corporation, the next step is to form your LLCs, each designed for a specific purpose. Filing articles of organization for each LLC with your state Secretary of State is the first step. This document is simpler than the Articles of Incorporation, but serves a similar purpose for an LLC. It typically includes the LLC's name, address, and the name of its members and organizers. It's the formal announcement that your LLC exists. Choosing a registered agent is important. This agent is responsible for receiving legal and tax documents on behalf of your LLC. Think of this as appointing someone to check your mail and ensure you never miss an important notice or deadline. Creating an operating agreement is perhaps the most critical step in forming your LLC. While not always legally required, it's important for defining the ownership structure, operating procedures, and financial arrangements among members. This agreement is the blueprint for how each room in your house operates, detailing everything from who can enter, how decisions are made, to how profits and losses are shared. Keeping distinct accounting and financial records for each entity has its own ledger for expenses and income. This separation is critical for legal and tax purposes as it supports the operational independence of each LLC under the C Corp umbrella. It's also essential for internal clarity, helping you understand which parts of your business are thriving and which may need more attention or adjustments. Maintaining separate records means having individual bank accounts for the C Corp and each LLC, as well as separate bookkeeping and financial statements. This practice not only aids in transparency, but also simplifies tax preparation and financial analysis, ensuring that funds and expenses aren't mistakenly mixed between entities. Establishing clear governance structures is similar to setting rules and roles for everyone living in your house. For the C Corp, this means defining how the board of directors operates, including their decision-making processes, meeting schedules, and communication with corporate officers. For each LLC, governance involves determining whether it will be member-managed or manager-managed and laying out the operational roles and responsibilities. This clarity is essential to prevent conflicts and ensure that each entity operates within its defined scope, adhering to both the overarching direction set by the S-corp and the specific objectives of each LLC. Tax planning for your S-corp and its LLC subsidiaries is a critical step that requires careful consideration and, ideally, input from a tax professional. The unique structure of a C Corp owning LLCs presents several tax implications that can be optimized to benefit the overall financial health of your business operations. For the C Corp itself, taxes are paid at the corporate rate on profits, and then any dividends paid out to shareholders are taxed again at their personal income tax rates. This double taxation is a well-known characteristic of C Corps, but can be mitigated through strategic planning, such as reinvesting profits back into the business or compensating through salaries and bonuses, which are deductible expenses for the corporation. Each LLC, depending on its tax selection, can offer flexibility to avoid double taxation. By default, LLCs are pass-through entities, meaning their profits and losses flow through to their owners' personal tax returns, bypassing corporate taxation. However, when owned by a C Corp, the LLC's tax status can be structured to optimize the overall tax burden, considering the goals of the overarching corporate entity and its subsidiaries. Deciding on the tax status for each LLC involves weighing the benefits of pass-through taxation against the simplicity and potential tax benefits of electing to have the LLC taxed as a corporation. This decision will impact how profits are distributed, taxed, and reinvested across your business entities. Staying compliant involves more than a one-time setup. It's an ongoing process that requires regular attention. Both the C Corp and each LLC must adhere to various state and federal regulations, which may include annual reports, tax filings, and maintaining up-to-date registrations. For the C Corp, compliance includes filing annual reports with the state, holding annual meetings, recording minutes from those meetings, and staying on top of corporate tax filings. These actions ensure that the corporation remains in good standing and avoids penalties or fines. Each LLC under the C Corp umbrella also needs to maintain its compliance, which can vary significantly from one state to another. This might involve filing annual or biannual reports, renewing business licenses, and managing payroll taxes if the LLC has employees. Regular audits or reviews of financial and operational records can help ensure that all entities are compliant and operating efficiently. Managing assets and liabilities effectively is important in protecting the financial health of your C Corp and its LLCs. Each LLC can be used to isolate different business activities, assets, or investments, limiting the risk exposure to the rest of the corporate structure. This isolation helps in case one venture faces legal challenges or financial losses, safeguarding the assets held in other LLCs and the C Corp itself. Effective assets management also involves strategic allocation of resources among the LLCs and the C Corp, ensuring that each entity has the assets it needs to operate successfully while maintaining the overall financial stability of the corporate group. Regular asset and liability assessments can identify potential risks and opportunities for reallocation or restructuring to better protect and leverage your business's assets. Your business structure requires an ongoing review and adaptation to remain aligned with your evolving business goals and external environment. Regularly assessing the performance, financial health, and strategic direction of your C Corp and each LLC allows you to identify areas for improvement, expansion opportunities, or the need to pivot strategies in response to market changes. This might involve forming new LLCs for emerging ventures, restructuring existing entities for better efficiency or tax advantages, or even dissolving underperforming LLCs to reallocate resources more effectively. Adaptation also means staying informed about changes in laws, regulations, and tax codes that could impact your business structure and operations. Being proactive in adjusting your strategy and structure can safeguard your assets, optimize your tax situation, and position your business for long-term success and growth. Setting up a C corporation to manage limited liability companies might sound complicated, but it's definitely doable with some good planning and help. This setup is great for business owners who want to work on different projects under one main company. It's a solid way to build your business with less worry because it helps keep your personal stuff safe if any of the businesses run into trouble. This means you can focus on growing your projects, knowing that the way your business is set up is smart and protects you. This structure is not just about keeping things safe. It's also about making your business run smoothly and letting you chase after many different ideas at once. And don't forget that if you would like to get help in starting your own C Corp, I highly suggest you reach out to Northwest Registered Agents by clicking my affiliate link down in the description of this video. They're professionals and they'll be able to help you out. Plus, clicking on my link doesn't cost you anything extra and it helps me support the channel. Thank you for watching. Till next time.